All right, let's dive right into today's explainer. We're going to tackle a question that trips up a lot of investors. How on earth can a bond with a juicy 15% coupon actually end up losing you money? We're going to walk through the exact numbers of a case study, and trust me, the result reveals a lesson that is absolutely crucial for anyone investing in bonds. So picture this. You're looking at an investment, and you see a bond offering a 15% annual coupon. Your first thought is probably, wow, a 15% return. That's fantastic, right? Well, as we're about to find out, that coupon rate is only one little piece of a much, much bigger picture. The real question we need to answer is, what did the investor actually walk away with in their pocket? Okay, so to really get this, we need to lay out the groundwork. Before we can figure out the end result, we have to understand the bond our investor bought in the first place. Every single number you're about to see is a key piece of this puzzle. So, here are the details. A company, let's call them Forazon, issues a bond. The face value is 32,000 shekels. That's the amount they promise to pay you back when the bond matures. It's a 6-year bond, and it has that really eye-catching 15% annual coupon, which works out to a payment of 4,800 shekels every single year. But here's the most important number on this entire slide. At the time, the market yield, what you could get on other similar investments, was only 10%. Remember that. And that brings us to our first big calculation. Now, you might think the investor paid that $32,000 face value, right? Nope. So what was the actual price they paid to buy this bond? Let's figure it out. To find the bond's market price, we need to calculate its present value. Now, that sounds complicated, but it's not. It just means we're figuring out what all those future payments, the 6 years of coupons, plus that final $32,000 payout, are worth in today's money. And to do that, we use that 10% market yield as our yardstick. Okay, so here are the inputs for our calculator. N is 6 for the 6 years. Now, this is super important. The interest rate, or I/Y, is the 10% market yield, not the 15% coupon. PMT is that annual payment of $4,800, and FV is the final face value of $32,000. So we plug all of that in to get the present value, and the price comes out to 38,968 shekels. So let that sink in. Our investor paid a premium. They paid almost 7,000 shekels over the face value. So why would they do that? Well, it's simple. Because this bond's 15% coupon was way more attractive than the 10% you could get anywhere else. Investors were literally willing to pay extra for that higher stream of income. All right, so our investor buys the bond, holds it for 1 year, and happily collects their first coupon payment. But you know how it is in the markets, right? Things don't stay still for long. The entire landscape is about to shift, and that changes absolutely everything. So, fast forward 1 year. Our investor has that first 4,800 shekel coupon in their bank account. But here's the kicker, the really critical change. The yield for similar bonds out there in the market has now shot up to 15%. This is a game changer for the value of the bond we're holding. So we run the numbers again, but we have to update our inputs. N, the number of years left, is now 5, not 6. And I/Y, the market yield, has jumped to 15%. That's a huge change. The annual payment and the face value, those stay the same. And the new price is exactly 32,000 shekels. This is just a perfect illustration of a core principle of bonds. The moment the market yield becomes the same as the bond's coupon rates, in this case, they're both 15%, the bond's price will trade at its exact face value. That huge premium our investor paid just 1 year ago, it's completely evaporated, gone. Okay, we've got all the pieces now. The investor bought for 38,968, they got 1 coupon payment, and they sold for 32,000. It is time for the moment of truth. Let's put it all together and find out what they actually made, or maybe what they lost. And you know what? Calculating this is actually pretty simple. It's a 3-step process. First, we're going to add up all the cash the investor got back in their hand. Second, we'll look at what they originally paid. And finally, we just calculate the percentage change. That'll give us the true return. Let's plug in the numbers. The total cash they received is the 32,000 from the sale, plus that one 4,800 coupon for a total of 36,800. We compare that to the initial investment of 38,968. So the formula is what you got back divided by what you put in minus 1. So what's the final answer? The real return was negative 5.56%. That's right, a loss. Even after collecting a hefty 4,800 shekel coupon, the drop in the bond's price was so big that the investor actually lost money. A far, far cry from that 15% coupon they saw on the label. So what is the big takeaway here? What's the lesson? This whole thing, this entire case study, it all boils down to one of the most fundamental, must-know relationships in all of fixed income investing. And here it is, laid out, plain and simple. The perception, driven by that shiny 15% coupon, was a fantastic return. But the reality, driven by that shift in market yields, was a loss of over 5%. Ouch. And here is the golden rule that explains everything. It's an iron law of finance. There is an inverse relationship between market interest rates and the price of existing bonds. When rates out in the market went up from 10% to 15%, new bonds became more attractive, so the value of our investors' older, less competitive bond had to go down to compensate. It's that simple. So I'll leave you with this question. The next time you're looking at a bond investment, what's the number you should really be focusing on? Is it that attractive coupon payment they're promising you, or is it the prevailing market yield that's going to truly determine the bond's price and your potential profit or loss? Understanding that difference, well, that's everything.